What's up, everyone? In today's episode, we will be talking about why I think it's not the best time to go short. Before jumping into details, let's take a look at the main data that came out last week. So we got a good numbers for GDP growth for Q3, which indicates us that we are not in the recession yet. Also, we had Powell's speech, where he apparently gave some confidence in the market. Some numbers on Thursday demonstrated growth in personal spending and personal income, which is positive for the economy. However, manufacturing PMI was lower than expected, which may be an early indicator that we are moving into recession. On Friday, we got, I would say, solid numbers for the labor market. So we got the expected unemployment rate, which is good for the labor market, obviously. However, this shaked the market because it gives more room for Fed to be more aggressive in tapering. Now let's see last week's performance through different sectors. Even though it looks pretty green, I would say we are in the middle of nowhere, right? Yes, we had some good performance stocks like Tesla, Meta, Netflix is really strong. However, we are approaching a significant resistance level on the S&P 500, which I will demonstrate you shortly. To be prepared for next week, let's look at the upcoming important data. So what do we have here? On Tuesday, core inflation rate. Ooh, that's something. Last time, lower than expected numbers pushed the market up by 5%. This day can be extremely volatile, so be careful. And on Wednesday, Fed interest rate decision and Fed press conference afterwards. That's even more interesting. However, the expectations are clear, so then what Powell will say is much more important. So this week must be really frisky, so please be mindful. Also, let me bring up the seasonal pattern of S&P 500. So we see that December historically is a quite strong month, and you are all aware of the Christmas rally happening during this period. So it gives some confidence for bulls. However, it might not be the case this year. And I'll show you what you should be tracking in order to avoid getting into the bull's trap. Before we move on to the main 5 indicators you should consider before going short, I would much appreciate if you liked this video, if you like it of course. So please smash this like button. If you don't like it, please leave a comment so I can understand why and improve it next time. Also, don't forget to subscribe to this channel if you don't want to miss my next episodes, where I will be reviewing a lot of market data, stock analysis, and of course, perfect timing for going into the market. Now let's discuss what you should keep an eye on. DXY, which is a dollar index, it has a negative correlation with S&P 500. So when DXY moves higher, then we can see volatility on the market. On the flip side is that when DXY moves lower, so it means that we can see some bullish sentiment on the market. What I noticed is sometimes there can be divergences that might indicate upcoming market period. So here you see we have growth in DXY as well as SPA has some growth, but then it turns out to be kind of bull's trap, and then we see that the market went lower. The same situation happened in the middle of September or somewhere here, where we see that the DXY was moving higher, and then we saw downtrend in the S&P like this. Let's move on. Now let's see high yields, which is smart money. And here I highlighted a few examples where you can see that there took place some divergency in between that high yields were making lower low, however S&P was making higher high, which could indicate for us that this is false uptrend and possibly bull's trap, which actually it was, and then we see this significant downtrend. Here we can see small consolidation. However, high yields were moving lower, which again was warning sign for the bulls that this consolidation might be in favor of downtrend continuation. Here we have quite similar case because high yields were moving a little bit lower, so we can see here divergency on 1 hour time frame. On the flip side, SPY was kind of moving higher, either consolidating, which gave us a good shorting point in the middle of August, where we can see this also huge move till new low of the year. Once I see kind of similar situation over here where SPY will be moving a little bit higher and higher, and high yields will be not confirming that move of the S&P 500 and making new lows or lower highs. It will increase my confidence upon going short. Now let's see VIX. So it is approaching very strong support level over here, which usually led to VIX blowout, like over here, like over here, over here, over here. And then we encounter some downtrend on the S&P 500, like here, over here, and what to expect here. I think you are all aware of that. These levels actually will indicate for big guys, hedge funds, that it might be good to hedge some risks so that they can buy puts, which will raise some volatility on the market, and essentially it will lead to S&P 500 pullback or even trend pivot. So small observation, for example, here you might see VIX consolidation in the meantime when S&P 500 was moving higher. So this is a really great indicator where you try to assume that we might be pulling back in the foreseeable future or even downtrend pivot. As of now, I see that VIX is moving lower, which is good for the bulls. What I want to see to go short is that VIX starts kind of consolidating over here when S&P moves higher. In this case, it might be worthwhile considering opening some short position or maybe increase your hedge. Also, let me share some observation on S&P 500. So last bear market lasted 61 days and eventually achieved 19% growth. Now we are approaching the same 61 days, which is going to be here, and almost reached the same 19% growth from the October low. Does it mean we will repeat the same pattern? Absolutely not. Another interesting watching is that every bear market rally was lower than 0.786 Fibonacci retracement. Like here, also here, and now we are really near by this level. So breaking this level a little bit higher will indicate to me that current trend is relatively stronger than all the other bear market rallies. So we might even go in a little bit higher, maybe to test highs of the August. On the flip side here is that it might be a good opportunity to go short because the risk reward over here is so tasty. For example, you can go short here with the risk higher a little bit of the August high. So it's like 2-3%. And then we also maybe go a little bit lower or maybe some pullback on the market, which with the same risk factor, or if we go to test previous low, so it's like about 13% downtrend, which gives me about 1 to 4 risk reward factor. So be careful now. That's all what I got for you today. Hopefully it will help you out. If you like this video, don't forget to thumb it up. Leave a comment if you have any concerns. Subscribe to the channel to get even more information. So guys, be careful in such a difficult market. Cash is also a position. See you.